Is the market's indifferent response to some good news a simple sign of fatigue after the strong run higher from early April, or maybe a hint of a tougher setup for stocks as we head into what should be an eventful summer? Let's ask Adam Parker, Trivariate Research founder and a CNBC contributor. Adam, good to see you here.
Thanks for having me.
So you can kind of play this both ways. Either the market's kind of gone nowhere from early November, which is true, or it's up a ton from early April, also true. Are we just digesting things here? How are you viewing it?
I think it's the second half of what you set it up. I think we're heading into some more concern. I mean, I thought we were funding the tax breaks with the tariffs. So like 1 + 1 doesn't equal 3, right? So do we want it to happen? Do we not want it to happen? There's a little bit of a math problem. I think investors I'm talking to today asking a little bit about the bond market. And, you know, when equity guys start doing that, that's always a little bit worrisome. I generally think the consensus view is we're going to continue to melt a little bit higher until we get a little more clarity on October earnings season, the July guidance for October. People know the numbers are too high, but they're sort of thinking, hey, the top 50 stocks can maybe handle a little inflation. Maybe the dollar weakening helps a little. Maybe oil's low. Maybe input costs are low. And so maybe the earnings degradation isn't as bad as we thought a month or two ago. So I find like people are positioned for us to head a little bit higher, and they're just saying either a big slowdown in the consumer or bond yields will derail my current, their current view.
In terms of the tariff piece of it, I mean, obviously, as you suggest, you can slice it any way you want in terms of what the implications are, what the goals are. But the bottom line is just that whatever you thought about this ruling this morning, you're not going to get resolution tomorrow. And it's like you thought maybe after the 90-day pause, you would at least know something firm about the rules from here and what we're going to settle out at. I guess you just have no hope of that. But to me, the bigger question is, what has the market already assumed? Because we've rebuilt the valuations. We're within 4% of the highs. I'm not saying that you're assuming great things, but you aren't assuming worst case.
I mean, I thought we were taught somewhere here that uncertainty is supposed to be bad for the price to earnings, right? Like if I don't really know what's going to happen, I probably should pay a little bit less until I have clarity. So I could see the logic today being, hey, things are a little less uncertain today than they were yesterday. I thought we were 10%. I thought we were working on China 30, and it's a little more uncertain. So I could see the multiple probably mark to market from yesterday should be a little lower. The earnings, I don't know. And I think that's the part where did the perception about growth just get better because maybe there's less chance we're going to implement things? I don't know. I would argue either way, we created a little bit of a ripple effect here where we're going to do some things with pricing, with inventory, with capital spending, with delays in spending. And I think you'll see some of that impact stocks 100 through 500 at least for the July earnings period. Yeah. So I think we're in a bit of a data vacuum here. With NVIDIA being considered like the last big company that reports.
Yeah, exactly.
And so,
well, I was going to say that does kind of sum it up to a degree, right? You kind of know what you had in the second quarter. You also had know what we had in guidance, and it was probably less bad than we thought it was going to be.
Definitely less bad. I think Visa's print. People are looking for real-time consumer prints. You could say in the last couple weeks the low-end consumer slowing. I think you could say Ross Stores little light. Definitely considered a skew toward the lower-end consumer. That the boxes, like physical retail boxes, have disappointed. I mean, if you strip out Target's online business, their physical boxes comped like down 5.5 against a down 4 a year ago. They're down 10% over a 2-year stack. It's $100 billion revenue. So there's definitely some consumer slowing at the middle to low end that's happening, and some price sensitivity. But I think the S&P is a weird index where the Mag 7 is 25% of the earnings and 30% of the market cap, and they're probably immune to a little bit of a stagflation fear. Sure. Bank earnings were good. So I think there's some offsets enough that it's hard to get too bearish right now. And what makes you get more bullish will be anything on the consumer and the industrial front that look a little bit more benign.
You mentioned clients, raising the specter of something going on in the Treasury market that could be a headwind. Yeah. I mean, what are we wishing for here? I wonder that to some degree, because some of the backup in yields over the last several weeks has clearly been the economy sort of hanging in there.
Yeah, better than people thought.
You're pricing out more Fed action for several months. And then people get fixated on the fiscal situation, but it's very slow moving. It's mostly unchanging. And we're kind of in the same range on the 10-year we were for, 8 months ago, a year ago.
Yeah, the 10-year's been super stable while the stock market's been volatile. I've noticed that. I think what I believe is true is that we don't want the Fed to do anything. Like if we just don't move the front end at all, we say, the economy's hanging in. We don't really need to cut right now. We're not seeing inflation pick up, or I'm not worried they're going to hike. Then I think the market, maybe has a slight, melt up with a higher multiple. But if they have to cut one or two more times, I'm not sure it's as great as you want it to be. Where, the market just rips higher because they're cutting. Because I think they're likely going to be responding to sort of enough deteriorating data points that they think it's required. And, the market will lead the Fed on that. So that's the challenge I have. I think pause is the best scenario.